day of the year. Vince Lorusso, Clough Capital President and CEO. Vince, Happy New Year. Thank you for being here. So we've made a lot of the S&P potentially notching another record, about 0.3% from that all-time high. But we got to give credit where credit is due, which is, of course, the Magnificent Seven, contributing to something like 65% of the gains this year. So the rule of diversification in 2023, not giving way to much upside. What do you recommend for investors as they're thinking about portfolio allocation for 2024?
Well, we do think it's time to see some broadening strength in the equity markets. I mean, obviously, the Magnificent Seven has carried the S&P to really high levels here as we think about all-time highs potentially at the close today. But we do think that the recent rally in small caps, if you look at the move in the IWM on the back of lower interest rates, we think that sets the stages for potentially a much longer rally than just a couple months that we've seen. And we think it's time for investors to be looking for active management, a more broadening strength of the equity market. And in particular, we're looking into some of those smaller and mid-cap areas.
Active management in the sense that you think 2024 will be more of a stock picker's year, or do you think that we'll see kind of this broadening out, rising tide, lifting some of the stocks that hadn't necessarily done as well in the first part of the year?
Yeah, so when you begin to see some of those dispersions that we're seeing in returns, when you see some of that broadening of the market into areas beyond the Magnificent Seven, even beyond tech, that tends to be an area where active managers can perform better. You know, fundamental research can identify opportunities on the basis of valuation, looking for earnings expansion, multiple expansion. And, you know, we do think that for such an extended period of time here, passive strategies have done exceedingly well. Allocating capital almost purely on the basis of market cap has been a very rewarding endeavor. But as we transition to a new level of interest rates and we think about dispersions of returns and, you know, the different areas of innovation that management teams are able to deliver to the capital markets now, we think that some of the equities that are less broadly followed, and that's not a very, you know, bold statement given the strength of the Magnificent Seven. So much of the market is not very broadly followed right now. But as active managers at Clough Capital and looking through the equity universe, we're seeing really interesting opportunities. And they're juxtaposed with compelling valuations because the IWM has lagged for so long. I don't know that we would broadly want to own every small cap, but if you can do the fundamental research, go out and find individual securities, we think equity investors are going to be rewarded for that effort.
Vince, maybe the standard pushback against that idea might be, first of all, Microsoft itself is basically worth all of the Russell 2000, give or take. So, you know, it's a lot of work to find the needles in the haystack in small caps. You have a very predictable story in some of these mega caps. And the other one is, I wonder if you were an IR officer at one of these smaller companies, the first question I might ask is, why hasn't private equity already bought you? Like, why are you, if you're an attractive business, why are you still public and kind of being neglected on the markets? I just wonder how you think about that working through. When you look back to the early 2000s when you had massive small cap outperformance, that came largely from mega cap growth collapsing, you know, and small caps picking up the slack.
Yeah, that's a great point, Mike. And look, the strength in the Magnificent Seven is deserved on some level. I mean, these are fantastic companies with wide moats and impeccable balance sheets, and we think they could continue to do very well. But when you look at the market capitalizations of those businesses and you think about a return on equity or a return on invested capital, it's just not as compelling. It may be a law of large numbers kind of a dynamic, but when you get into market caps that are, as you mentioned, Apple the size of the IWM, or you start to think about these companies as a percentage of GDP even, and they're enormous. I mean, it's just, you know, somewhat unprecedented. The smaller companies have had to earn their way through a difficult period, right? The COVID gyrations and the inflationary environment that we've just been through and is potentially under, somewhat under control at this point in time, that sets up a really good framework for small caps. So whether it's the self-help things like expanding margins by controlling costs or moving into adjacent markets and geographies or business units, I do think private equity will play a role here. Share buybacks may even play a role. You don't see that as often in the small cap arena, but I think management teams are doing a good job of getting out there, and it's largely been a tree falling in the woods. Nobody's there to hear it if all the money is piling into passive strategies and the Magnificent Seven. But I think this recent rally that we're seeing in the IWM and some dispersions of returns, it tends to set up a longer period of outperformance than just a couple of months.